Hi everyone, welcome back to Be Rich. There's a new effort from our team to create this podcast channel where we'll be talking about information and educational topics related to economy and finance and investment. So the first one which we're going to talk about today is how inflation works. Inflation affects all of us, but very few of us understand how it works. Why are homes and other things becoming more expensive than it was 10, 20 years ago? The simple answer is inflation. Inflation means a general increase in price in goods and services in a nation's economy. In India, we track inflation through our consumer price index, whole price index, different methods and means we use to track inflation. It tracks the price of goods on an average household buys. They have a mixed basket where they choose different products and they try to measure the price increases and they create an index where inflation is rated. But before we talk about what causes inflation, let's first talk about two extreme cases in which prices rises too quickly almost every day, another where prices don't increase and start dropping. Hyperinflation. Hyperinflation can lead to an economic disaster that can cause serious harm to people and the economy. When prices start rising every day in the economy, about 100% a day, which means doubling every day, it is called hyperinflation. Hyperinflation occurred in Germany between 1921 to 1923. A loaf of bread, which used to cost 160 marks at the end of 1922, cost over 200 billion marks by the late 1923. Why did it happen? It created a shortage in Germany of almost everything because there was more money in the economy than goods can be purchased. The German government printed a lot of money to pay increased wages to striked workers. These workers have more money than they had in the past without an increase in productivity. So workers will purchase more goods, and as a result, demand goes up faster and more supply of goods, which causes high inflation. So more than the supply of goods, which is what caused high inflation. However, there were also other reasons for hyperinflation. For example, the government started paying down debt by printing new currency, which also caused hyperinflation. Another example of hyperinflation is Zimbabwe, where prices rose in mid November 2008 with a rate estimated at 79 billion 600 million percent per month, which led to an abandonment of the nation's national currency. The causes of the Zimbabwe's hyperinflation were its government's printing of money to pay off the rising national debt and the significant decline in economic output, as well as the political corruption which worsened the situation of Zimbabwean economy. Hyperinflation erodes the wealth of savers because money will be losing value every day. The winners in hyperinflation are the debtors. The borrower will pay less in real terms than they borrowed because the currency will be losing value every day. Hyperinflation encourages people to consume all their income as soon as they receive it because people expect prices to be even higher tomorrow. It will be unwise for people to save their income. So many people don't save their income. There will be almost no savings for investment in the economy, which can produce economic growth. There will be no economic growth if there is no saving because of hyperinflation. Now let's look at the reverse, which is called deflation. Most people think prices of goods decreasing in the economy is good because things will cost less. They can buy more goods. But the problem is that prices start to decline. Everybody will expect prices to fall more and more. So people stop spending today to buy goods in the future. When people stop buying goods and services, it affects the producers of the product. So they have less income because the consumers are not spending. To cut costs, the companies will fire employees because of its lower earnings, which can lead to higher unemployment and lower economic growth because of people not spending. The effects of deflation is much worse and harmful because the economy becomes stagnant, which means economic growth in the economy will not occur. Most people see their income starting to decrease and or they get fired as deflation rises. The best case of deflation is Japan. The economic growth in Japan for the last 20 to 30 years has been relatively flat. It didn't have any economic growth due to deflation. In Japan, prices of goods started to decrease, which changed the expectations as more people expected prices to fall further and further in the future. It was a self-fulfilling prophecy as people believed the prices will decrease. Demand in the economy would go down, which led to further decline in prices as there was more supply than demand. When households stop buying products from firms, these firms will get affected, so they tend to fire employees and produce fewer goods. It leads to a decrease in the economy. It leads to a decrease in the income of all people in the nation's economy. In 1995, Japan's GDP was $5.5 trillion and the per capita income was $44K. In 2021, Japan's GDP was $4.9 trillion. Per capita income was $39K. Japan's economy isn't seeing any growth. It has become stagnant, and its GDP and per capita income decreased for a couple of decades due to deflation. This is why falling prices in the economy is not as good as it seems for most people. Is inflation always bad for the economy? That's the question we always wonder. We as consumers don't want inflation because things will become more expensive and we can't buy as many goods as we used to. But some levels, like 2%, is considered healthy for the economy because there is more currency in people's hand. More people will buy more goods and the demand of products will increase. There will be more demand for supply, producers will produce more, and more will be made to meet the excess demand, which leads to a rising growth and rising economy. This is why some levels of inflation is good and it's seen as a good sign of a healthy economy. What are the causes behind inflation? Many famous economists have studied the causes of inflation and how it affects the economy. Most economists disagree about the different causes of inflation. There is no straightforward answer to this, believe it or not. We will discuss different viewpoints proposed by the famous economists about the causes of what's behind inflation. The modern quantity theory of money. It was formulated in the Renaissance by the astronomer and mathematician Nicholas Copernicus in 1500s, mid-20th century, and later advanced by Anna Schwartz and Milton Friedman, who became famous for their work on modern quantitative theory of money. In simple terms, the modern quantitative theory of money states that an increase in supply of money with output, such as goods and services, remaining the same will cause inflation. The quantity theory of money states that the price of goods are directly related to the supply of money in the economy. Imagine an economy where there is only one type of good and there are 100 people each who have $1 to buy that good. So the money supply is $100, and if we pump another $100 into the economy while the output remains the same, everyone will have $2 to spend and each person will tend to buy more of the units and the good will build up the demand and the price will start to rise. With the output, goods and services remain the same, but the supply of money increases, inflation will occur and will increase the price of goods in the economy. Milton Friedman argued that the government will keep the money supply fairly steady, expanding it slightly each year to allow natural growth in the economy. He famously said that inflation will always and everywhere be a monetary phenomenon. Today, central banks like the Fed in the United States and ECB in the European Central Bank and the RBI in India perform monetary policy and set targets to keep inflation around 2 to 3% to keep the economy healthy. Modern quantitative theory of money is more complex than this. To avoid all the jargon and unnecessary details, it simply states that as the government prints more money in the economy while output remains the same, the prices of goods will increase and drive inflation. Pull and demand of inflation. What is pull and demand? Pull and demand occurs when, due to the increased supply of money or the increase in government spending, the demand of goods in the economy increases, thus causing a demand and pull inflation. Demand and pull inflation. What is demand and pull inflation? Demand and pull inflation occurs when, due to the increase of supply of money or the increase in government spending, the demand of goods in the economy increases, thus increasing the demand and pull of inflation. When people have more money in their pockets, they will buy more goods, and the demand will rise faster than the supply of those goods. Thus, the price will rise, and there will be too much money chasing too few goods in the economy. Demand and pull inflation occurs when the demand of goods and services exceed the production capacity. When firms have excess demand and they tend to hire more workers to produce goods to meet the demand, and the unemployment rate will fall. When firms produce more and sell them, it will also tend to increase the real GDP in the economy. Some level of demand and pull inflation can increase real GDP. Cost and push inflation. When there's a shortage of workers, and firms may raise salaries and bonuses to attract new talent and employees. But these increases in bonus and increases in cost of production, which would be passed on to the consumer, is a form of higher price cause inflation. Employees will have more income due to the rise in salary, and they will tend to spend more money to buy more goods, thus increasing the demand for goods. When demand outpaces faster than the supply of products, it will cause prices in products to rise and cause of inflation in the economy. When there is an increase in the cost of production inputs, such as raw material and wages, used for making the final product, it will also be passed on to the consumer, thus causing inflation to the overall economy. For example, the price of oil goes high, it causes inflation in the economy because oil production and the input of is the input for many goods in the economy. So the price of oil going higher pushes up the cost for everybody. That in turn is passed on to the consumer. Many firms who depend on oil will see the prices of their production input increase due to high oil prices. Then firms will pass on the cost on to the consumer by raising their product prices to stay profitable. And this in turn causes cost push inflation in the economy. Cost push inflation can lead to higher unemployment and decline in the real GDP. When prices of production inputs, let's say the oil prices increases, then many firms who depend on oil to make their final product will see a cost in production rise. These companies want to remain profitable, so due to the higher cost of production, they will cut back on other costs to improve their earnings. The single most crucial cost for a firm is the employees' wages. So firms will tend to fire and cut wages because their cost of production has increased. When firms have fewer workers, they tend to produce less, which means fewer goods are brought to the economy. Therefore, the decline in the real GDP and higher unemployment occurs. Built-in inflation occurs when employees expect prices of goods to rise in the future, when they will demand higher wages from their employers to keep up with the future inflation. When firms increase their employees' wages, it means employees would have more income, so they will spend more buying larger number of goods because of the fear of the prices to go up in the future. Thus, more people suddenly start buying more goods. Demand will increase and causing inflation and a rise in prices. This type of inflation occurs if more people expect prices to rise in the future, then their actions make the price rise, causing inflation in the economy. When firms increase wages because of workers' demand, the firm's cost production also goes up. It will be again passed on to the consumer in form of higher prices, which again causes inflation. So it's a self-fulfilling prophecy, as Anand has always told us. Built-in inflation happens because people expect prices of goods to rise. Then their actions will move the prices of goods to a higher level. In summary, demand pull inflation occurs when demand is so high and production can't keep up. This causes inflation. Cost push inflation occurs when prices of the input, such as the raw material and wages to make the final product, when they rise, when that is passed on to the consumer in terms of higher cost, causes inflation. Built-in inflation occurs when people expect prices to rise in the future and demand higher wages for their employers. Those extra wages in turn will push prices of goods higher and higher, causing inflation, becoming a self-fulfilling prophecy. How to protect yourself from inflation? This is a question which has always been asked. The best way to protect yourself from inflation is to invest in assets historically that had beat inflation in the long term, that will preserve your real purchasing power and even grow you wealth. So what are the investment classes that historically beat inflation? Some of the investments that have historically beat inflation are as follows. Stocks. While a single business or a stock may go up and down, but if you have invested in your money in the broader market, in an index such as the Nifty 50 or the Sensex, which is the list of 50 of the largest companies in India, while a single business or a stock may go up and down in the market, the whole market as a whole, such as the Nifty or the Sensex, over a long period of time has always been going up by a percentage of 10 to 12%. So by investing in the stock market, such as the index funds, such as the Nifty 50 and the Sensex index fund, we tend to beat inflation by getting a return of 10 to 12% annually, while inflation in India stays at 7%. So this is one of the ways we tend to beat inflation and also keep our purchasing power and also grow our wealth. Another way we tend to beat inflation is gold. Gold is always considered to be by many as a perfect hedge against inflation to protect your wealth. Whenever there is fear in the financial market that the inflation is too high, most investors turn to gold because gold prices usually move higher than inflation. But one major drawback is that gold, unlike stocks or bonds, is not an income generating asset by itself. The only way a gold can get a return is gold sees prices. The only way to see a gold return from gold is to see price appreciation. In long term, stocks and bonds have always outperformed the price increase in gold. So that is why we always advise you guys to invest in the Nifty 50 or in an index fund. And so gold always beats inflation and preserves your purchasing power. It does not generate extra income or wealth as stocks and bonds do. One of the other asset classes which we always advise people to look into as an investment is bonds. The average annual return of investment in corporate bonds has can range anywhere between 7 to 12% in India. Although bonds may protect you from inflation, they won't grow your purchasing power as stocks can. That is why we also advise you to keep switching between bonds and stocks based on how the market is moving. When the market seems to be too much in a bull phase and seems overpriced, we advise you guys to stay in the bond market. When the market corrects and the prices look very lucrative in the stock market, at that time we ask you to move your funds from your bond to a stock market. So by moving your funds from the bond market and the stock market and oscillating your investments, you can see very good growth and very good appreciation of your initial capital investment. To conclude, central banks want to keep inflation rates around 2 to 3%, which is considered to be the reasonable rate of inflation to keep pace with real economic growth. Many economists may differ about the causes of inflation, but the thing is, inflation affects most regular people with fixed income salaries. When inflation gets too high, it has a damaging impact on the national economy and its citizens. The best way an individual can prepare for inflation is to invest in assets that have historically beaten the inflation. So, I hope you guys found this little podcast on inflation interesting and informative. Please do share your feedback down below on what are the topics you guys would like to hear on our podcast in Be Rich. Thank you for joining us on Be Rich today. As always, do subscribe to our channel and turn on the bell notification icon so you'll be notified every time we put up some new content for you guys. Thank you.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.